Buying life insurance is one of the most important investment decisions we make. But how do we go about doing this? Now, if we were living in the 19th century, this would not be very difficult. You would go to the insurer, pay a calculated premium, and get a corresponding economic cover to take care of your family's financial needs after you're gone. But with time, our needs have evolved, and so has life insurance. Which is why today, when we go out to buy life insurance, there are so many options. Options that don't just cover unforeseen death, but also help grow your investment to meet other life goals. So, how do we decide what kind of insurance we need to buy? Term plans, endowment plans, and ULIPs are the three broad categories of insurance plans. Let's understand how these different offerings work. Term insurance. If you are looking for a pure risk cover instrument for those dependent on you, then you would take term insurance. Investing in term insurance is like planting a tree that only provides shade for your family. It is the most affordable form of life insurance plan. It provides a high-risk cover by paying out lesser premium. In case of death, the insurance company pays the sum assured to the nominee or beneficiary. Typically, the maximum sum assured as death benefit is 20 times the annual income of the policyholder with no maturity benefit. Term insurance, however, has no investment benefits, which means it does not give any returns or money back. Mortality charges apply. Endowment plan. An endowment plan is ideally suited for a person who wants insurance with an investment component but is risk averse. Investing in this policy is like planting a fruit tree. It gives both shade and fruits when it matures. Unlike term plan, endowment plan pays a sum assured along with profits in both the cases, death and survival. This plan charges a higher premium which is invested in equity and debt markets. Most endowment plans invest in debt instruments and are less risky. The risk of investment is mostly borne by the insurance company as it offers a fixed return guarantee along with potential upside. The sum assured as maturity benefit is not great but sufficient to be used as a defensive investment option. This plan typically generates returns in the range of 4 to 7%. In this case, mortality and fund charges apply. ULIPs. ULIPs provide the dual benefit of life insurance and investment, meant for those of you looking to grow your investment at an aggressive rate. It's like growing a cash crop. If the weather conditions are conducive, you make a healthy output. If not, you run an investment risk. The investment component here is linked to the capital market, which makes the product a high-risk, high-return play. The performance of the plan depends on how well the markets do, with the risk of investment return being borne by the policyholder. The sum assured or fund value is paid out in the event of death. The payout could also be the higher of the two amounts. However, if the policyholder outlives the policy term, the company will pay out the fund value along with bonuses accrued, if any. It also caters to emergency needs since you can encash investments partially midway to bolster your finances. ULIPs can be used for creating a corpus for meeting life goals such as child's education and retirement, while at the same time retaining a life cover. Insurance companies offer a wide range of ULIP products to suit your risk-taking ability, equity funds, debt funds, and balanced funds, and also provide the flexibility to switch between these funds. Various charges and fees are levied by ULIP products that include mortality charge, premium allocation charge, fund management charge, policy and administration charge, surrender and switching charges. Now let's see how your premium of 10,000 rupees works over a period of 30 years in each of these categories. A term plan can get you a sum assured of 1 crore to 1.25 crore rupees depending on the company and the plan chosen. An endowment plan will create a corpus of approximately 3 to 5 lakh rupees of sum assured with a potential income of 5 to 6 lakh rupees over and above the sum assured. ULIPs will provide total returns depending on the linked product, equity or debt. Usually 4 to 8% per annum after charges, that translates into anywhere between 5.5 to 12.3 lakh rupees. Hope this was helpful. Invest wisely.